Good morning, everybody. It's John King with Summit Funding. It is Friday, the 24th of January in the beautiful 2025. We are 5 days into the new presidential administration. Lots of things that are happening right now, lots of news and a lot of unknowns. And so I'm going to really focus on today a couple of things. First of all, quick market update that I'm going to cover on kind of where things are at. But I'm actually going to dive most importantly into an important topic that if you haven't been thinking about, you should. Whether you're a current homeowner or a future homeowner, insurance. Homeowners insurance is a major issue, and I'm going to dive into it today and really help you understand how it would impact you as a home buyer, how it would impact you as a current homeowner, and what things you need to be thinking about. Excuse me. So let's dive in and get started. First of all, quick update on the markets. It's busy. We've got a lot of activity happening here in January, but rates are up. And it's creating a lot of buyers saying, hey, I'm not really sure if I want to move forward right now because I can't get the buying power that I'd like to get. And so that's creating some concerns. And part of it is coming from insurance, which I'm going to spend some time talking about in pretty good detail today. But as far as the market itself, we've got the Fed that is meeting next week. We expect the Fed not to change anything, which is not good news. It was clear the Fed was going to lower rates. They did. And now it's pretty clear they're going to stop. And we don't see them lowering rates anytime in the next 6 months. And remember, the Fed doesn't have to lower interest rates for mortgage rates to go down. We saw mortgage rates go from 8.25% down to 5.9% between October of 2023 and August, September of 2024. It wasn't until the Fed started lowering their rate that mortgage rates went back up. Call me crazy. It shouldn't go that way, but it does. So that's the market update in a nutshell. It's still not active like we think it should be this time in January. We usually see more activity. There's some activity, but not as much as we would have expected. But I want to really shift right now to the big topic I want to talk about today, which is homeowners insurance. And I really want to focus on, first of all, why getting homeowners insurance is harder than it ever has been. We know that there's a lot of major catastrophic events that have happened just in the last month, let alone in the last year. We've had hurricanes last year that impacted the East Coast. We've got major fires that impact Southern California this year. We had the Lahaina fire a year and a half ago. So major challenges that are creating more and more claims for insurance. And to understand this, we first have to really quickly go take a walk down memory lane and say, well, where did insurance come from? It was actually, my understanding is Benjamin Franklin that was the first one that really created this concept and said, hey, let's all pool our money and put a little bit of money aside so that if something bad happens, nobody has to pay all of that out of their own pocket. The concept is great. The problem is we've become spoiled. We've become spoiled because we've kind of become to expect that our insurance rates are going to stay where they're at, even though the cost to replace property, the cost to replace vehicles has gone up. Inflation has caused those costs to go up. And then you've got the number of claims that's gone up. But nobody wants to pay extra. And it's been a bit of a race to the bottom when it comes to the insurance companies because they've been focused on, well, how can we get more business in the door? And we got to figure out getting more business in the door means maybe we need to charge lower fees. Maybe we need to find more creative ways. Well, this actually sounds and smells a lot like the subprime crisis that happened 20 years ago. So 2004, 2005, and the mortgage world said, my gosh, let's have a race to the bottom and let's see how we can just get more people into homes for cheaper prices. And they started doing creative things. Well, that didn't end well. And I'm a little nervous about the direction we're going with homeowners insurance. And part of this really is a self-inflicted wound from the regulatory level, because a lot of state agencies, especially in California, they suppressed how much insurance companies could raise their rates. That sounds great. As a homeowner, I want them to suppress how much we can raise rates. I would love if right now the state government could step in and suppress how much money I have to pay for a dozen eggs. You guys bought a dozen eggs in the last month. Crazy how much eggs are costing. Wouldn't it be fantastic if we could just wave our magic wand and say, let's make those prices cheaper, even though market dynamics are saying it should be more expensive? Well, that's become the crux of the issue, is that the insurance companies have continued to find different ways of offsetting their costs, and they're now underwater. A lot of insurance companies have stopped writing new policies, and it's created problems for both potential new homeowners and existing homeowners. So I'm going to talk about both categories, but I'll tell you it's getting harder and harder because we've got fewer insurance companies offering insurance. They are continuing to decrease the amount of coverage and increase their premiums, and it's creating a problem that is continuing to get worse, especially with all of these additional claims that are coming from the fires, from the hurricanes. And unfortunately, it doesn't seem like this stuff's going to stop anytime soon. And so for insurance to continue to function, they have to be able to receive enough income to offset what their costs are. So let's start with if you're buying a home. Okay, so I called the subject how insurance could cost you your home. Now that means it could cost you your home if you're a buyer. It could actually cost you your home if you're a current home owner. From a buyer's perspective, you've got to start shopping for insurance early. In some cases, you literally have to start shopping for insurance before you start writing offers on a home. Because if you're in a high fire zone, you are going to have significantly higher homeowners insurance. I have a client recently who was shopping up in the Sierra foothills in actually got in a contract on a home in Sutter Creek. So that is basically just east up the hill from the Central Valley, Stockton area. And a beautiful home, they got into contract on it. And I had said, hey, I'm nervous about insurance. And the client said, well, I'll get to that. That's handled after we get over all of the other things like the appraisal and all the rest of it. And I said, no, especially in your high fire zone that you're in, you need to start shopping for insurance now. Like you need to get me insurance in the next day or two, because we're really close to the maximum of what they qualified for. Well, we were budgeting on this home about $150 to $200 a month for insurance. So that's about $2,400 a year. That should be pretty average for the price home that they're looking at. Well, they ended up getting an insurance quote that was about $6,000 a year. So they were having to pay $500 a month or $300 a month more than what we were originally projecting. Now, it's impossible for me to guess insurance at all, let alone guessing insurance in high fire zones. So if you are in a high fire zone, if you're in a hurricane prone area, you've got to start researching early, and every house is going to be different. If you have defensible space, you can get cheaper insurance. There's lots of pieces to this that you need to start digging into early. It may actually change what types of homes you are shopping for. It may impact the price of the home, because the homes that have the least fire risk, let's call it that. So the homes that have the big defensible space around them, that have roofs that are fireproof. The Getty Museum is a good example. I read an amazing article in the Wall Street Journal. I'm going to digress for a second. The Getty Museum down in Los Angeles survived the Palisades fire with literally flames all around, lapping up against the museum grounds, because they had built the entire museum to be fireproof. They literally had roofs of all the buildings that couldn't be burned. They've got sprinklers that came on when it sensed that there was fire or had an alert that there was a fire nearby. I don't expect anybody to do that on their home. But what I am telling you is the homes that are a greater risk to burning because they have not had a space cleared around, or they had an old roof, those are the homes that are going to have the most expensive insurance. And it is specific to the home. It isn't just, insurance is around this price. Now, if you're buying in, downtown San Francisco, well, then, yeah, you got earthquake issues, but you don't necessarily have the same issue about, hey, is there defensible space around it? But when you're buying in a high fire zone, that's a big deal. And a homeowner may charge more for a house that's going to have lower insurance premiums. That actually is starting to become a thing. So it can impact your shopping and what you're looking for and what you're trying to buy. And it may, in fact, stop you from buying the home that you're in escrow with because you have insurance. I had another client last year in Lake Elsinore. Same thing. The insurance came in significantly higher. We ended up having to pay off some debts in order to get their total debt to income ratio low enough to qualify because the insurance was too high. I had a client a year ago that was in contract to purchase a property in Angels Camp, again, Central California foothills. That insurance came back at $17,000 a year. We're talking about almost $1,500 a month for homeowners insurance. And this was an $800,000 home. And they are looking at $1,500 a month for homeowners insurance. The buyer canceled. Okay, this was a year ago, and we've had way more issues with insurance in the last year. And so it's something to be very aware of. If you're out shopping for homes, you need to start shopping for insurance early. You need to engage your insurance agent so that you at least have a feel for what regions are going to be high fire zone. There's a mapping system that they use from CAL FIRE, and the insurance companies have their own mapping system they use so that you can see what regions have what level of fire zone. Or earthquake, or well, earthquake isn't as big of a concern, but definitely earthquake is a big concern, but earthquake isn't an insurance calamity right now. Hurricane is a major issue. So we're seeing issues in California. We're seeing them in Florida. We're seeing them in Texas. The biggest ones I'm seeing, though, are in California and in Florida. But even up and down the East Coast, we're seeing it as well. So you have to be aware. And you got to understand, as I said earlier, how did we get into this mess? From a national perspective, we've just pushed the can down the road, kicked the can down the road too long. And this is becoming a bigger issue, and it's becoming now an issue of affordability. Affordability is a major challenge when we're talking about future homeowners and being able to buy a home. And interest rates have gone up, house prices haven't gone down, and in a lot of cases they've continued to go up, and yet our income hasn't raised significantly. And so how can people afford to buy a home? That's a big question that's becoming a bigger question because insurance is becoming more and more and more expensive. I'm sensing some insurance companies just don't want to write policies. I have a client right now that we are late to close escrow for her because the insurance company that she was using took 2 weeks in underwriting and still did not finish. So I had her switch to a different insurance company. That insurance company issued a policy in a day, but it was too small a coverage. And so we said, hey, we need you to increase the coverage amount. And that insurance company said, sure, but it'll take us a week to review and issue an updated policy. We don't have a week. She had to switch to another insurance company. They got us insurance for the right amount in a day. So insurance is a major issue when you're looking to buy a home. And this has all come from just the can being kicked down the road. And it has no longer got road left to be kicked. And so the insurance prices are going up. The insurance companies are cutting back. They're being way more selective. We're having issues right now. Some insurance companies are saying we're not insuring homes that have roofs that are older than 10 years old. 10 years old. Really? You're not going to insure a house because the roof is older than 10 years old? You got to be careful because some insurance agents will tell you nobody will insure that property. Well, for a while I believed that. Now I'm realizing, no. There's different insurance companies that have different appetites. But you got to be careful because insurance is a problem only when you have a claim. If you don't have a claim, who cares whether you have a good insurance company or not? But when you do have a claim and you have the wrong insurance company, now it's a nightmare to get your payout. So it's a catch-22 because a lot of the largest, most stable companies have pulled back. They've exited issuing new policies. They're more restrictive on what policies they will issue and are saying things like, hey, you've got a tree branch that's overhanging the roof. Hey, you've got some moss that I see on the roof. You are being very hyper criticized. They're being hyper selective about what homes they're willing to insure, but they're also the biggest, most stable companies. So can you find somebody else who will offer you insurance? Yes, you can, most cases. But it's going to be potentially a bigger challenge if you need to file a claim. They're not going to have as many. Oop, there went my video. I don't know how that happened. Oh, I know exactly how that happened, but hold on a second. Let me fix this and just change to my other camera. My ugly camera. All right, there goes my ugly camera. Let's fix that right there. All right, let's keep going. Beautiful. All right, so I know we've got some questions here. I've got more I want to cover, but let's make sure I get to my questions. Okay, that's about Dream for All. All right, so somebody asked me a question about insurance. Can I recommend the best insurance companies or let you know a list of providers who are genuine? I'm going to push this up and forget about my background for a minute. No. Here's what I'll tell you. There's two ways to go about getting insurance. You can go through an insurance broker or you can go through what's called a captive insurance company. So a captive insurance company is companies like State Farm, AAA, Nationwide. They're issuing policies only from their company. If you go captive, those are some of the largest companies that are very, very stable for the most part, versus if you go with an insurance broker. They're going to sometimes be able to sell to the large companies. Sometimes they're going to have to find smaller companies. So an argument says talk to both. Talk to someone who is both talk to a person who is captive with a large company, and then talk to someone who is a broker and compare and contrast. Okay, that's the first and best answer I'm going to give you regarding that piece. The other thing that I will tell you is your insurance options. Sometimes you don't have a lot of choices. And so sometimes you're literally going with, hey, I need to get a home, and this is my only way to make that happen. And so that's, I'm in contract. I want to get this home. Hopefully down the road, the insurance crisis is rectified and you can get a better policy. And so there are times when people are taking higher deductibles, people are taking a little bit less coverage. And so there's some sacrifices that people are making. I do see the Dream for All question. I'll answer that in just a couple of minutes. I want to talk about what it means for existing homeowners. So here's the deal. A lot of insurance companies are literally going out and they are having drones flown over your home to take pictures and see if there's any issues. If you have a trampoline in the backyard, they might say, hey, I'm not going to cover you anymore. If you have trees that are hanging over the roof at all, I'm not going to cover you anymore. If you have moss on the roof, I'm not going to cover you anymore. If you don't have defensible space, then you're not going to cover you anymore. Now you can fight that. You can fix it. You can prove that you fix it. I heard a story yesterday about somebody in a high fire zone who got the local fire chief to come out and issue a certification saying that he is defensible and he has defensible space, and his insurance company reinstated him. If you have good insurance, you want to fight to keep it, because if you lose that good insurance, especially with a large reputable company, it's going to be almost impossible to get it back. And so fight to keep it. Argue, fight, go to the state insurance commission and say, hey, what else can I do to fight to keep this insurance? Do not let them cancel you if there's a way to keep it. But here's the other challenge. You're looking at significant increases for a lot of homeowners. I have a client who has a home, again, a lot of them in the foothills, obviously the high fire areas. She bought a home with me 4 years ago. Now you're going to say, oh my gosh, I wish I was her. She bought the home, great price on the house, great interest rate. She's at a 2.9% interest rate. Her homeowner's insurance when she bought the home was $50 a year, 50. Now mind you, this house was $230,000. You're like, my God, why is she complaining? Because her insurance just went up by $400 a month. Her payment went from $1,500 a month to $1,900 a month last year. Just like that. She had no control. It was the same insurance company that she had, and they renewed her to a higher insurance and said, hey, you are in a higher zone. Actually, I think she had to switch to California Fair Plan. But she had to get new insurance, and it significantly increased her cost. Thankfully, she's able to afford that increase. There's a lot of people who aren't. There's a lot of people that I am nervous about that are going to be in a position where they cannot afford to keep their home. Now, the good news, if you call it that, is that most people have a good amount of equity in their property. Now, if you bought the house recently, you don't have that much equity in the property. But if you bought it anytime before the last 3 years, you have a good amount of equity in the property. So are we going to face a calamity like we had in 2008 where people could lose their homes because their payment goes up? I don't think so. But some will. Some people will lose their home, just like people lost their home in 2008. Because in 2008, your interest rate went up because people had adjustable rate mortgages. And that meant that you couldn't afford to make your monthly payments and you couldn't refinance and get the payment back down. Well, we've said for the last 15 years, that's never going to happen again. Why? Because everybody has a fixed rate mortgage. We don't have to worry about the fact that interest rates are going to go up for people who are existing homeowners. And that is a very true statement. Which means that even if house prices drop some, if you're an existing homeowner, you can keep making your payment, because unless you lose your job, you can continue to afford to make your monthly payment. Unless your homeowner's insurance goes way up. In California, your property taxes are capped and can only go up by 2% per year. Now, in other states, your property taxes can go up a lot more. But the biggest concern that I have is homeowners insurance. And existing homeowners are going to be in a position where they're going to get canceled and they're going to have to get a force-placed insurance policy from their lender. Those are super expensive. So if you can't get your own insurance, your lender's going to force a new insurance policy on you, and it is stupid expensive. So you're going to get an even more expensive insurance policy that has even less coverage because it's really only covering the dwelling. It's not covering you and your property because the lender doesn't care about your property. Forgive me, I'm a lender, but as a bank, When you have a loan on a property and you choose not to have insurance, now I know that I'm saying that harshly because you're not choosing it, but if you don't get insurance, then the bank says, great, then I'm going to force you to buy this policy and I'm going to add it to your mortgage. You're going to have to include it in your mortgage payment. And we're going to do the least amount of coverage to protect us. So that puts you in a position where you're paying more for insurance and you have less protection. People are going to lose their home over it. That's my fear. It's going to happen. And most people should be able to sell their house, and you got to live somewhere else, and rent is stupid expensive. So if you look at somebody who bought a house 10 years ago and you're like, man, they should be happy. They got a low payment. They got a low rate. That's great. But if they can't afford the increase in the payment, mom and dad are on a fixed income. They're getting Social Security. They can't afford that higher monthly payment. So now what? Now they keep making the payment. They end up in foreclosure. The bank takes it and they lose all their equity because they didn't want to sell the house, but they waited too long. If they sold the house, at least they could get the equity out of the house. And then they were in a position where they could at least live off of that money. But think about how much higher their rent payment's going to be now. This is definitely a crisis that is coming up. I do not see it as being the crisis like we had in 2007 and 2008, but it is going to cost some people their homes. You absolutely could lose your home over homeowners insurance. And that's something that you need to be fully aware of. So I'm going to talk in a minute about what you can do to protect yourself. But first, I'm going to see, you got some questions here. All right, one more. How come insurance is considered moderate? How much home insurance is considered moderate for $100,000 worth in San Joaquin County, where the flood factor is 5? So that's a super specific question. Forget that I'm talking to this camera. That's a super specific question that is really hard for me to answer. As an industry, we take your home value times 0.35%. Okay, so 1/3 of 1%. And so if you've got a home that is $100,000 home, then 1% of that is $1,000. 0.35 is $350. So our calculation says, well, a $100,000 home should be $350 a year, or about $30 a month. $200,000 home, $60 a month. $300,000 home, $90 a month. But then you have flood insurance like you talked about, and that depends on the flood zones. It depends on whether it is public flood insurance or private flood insurance. There are so many moving parts to this. It's crazy. That's where you've got to have a great insurance person. Every single week, I am presenting to you guys information to prove to you I am the lender of choice and that I can help guide you from a lending perspective. You need to find somebody from the insurance side. I can help you find those people in some markets and other markets. You need to lean on other resources like your realtor, your friends and family. Call the company that does your car insurance maybe, but don't just stop there. Just because somebody says yes does not mean they're the right one to give you the advice. And that's what you need, is good advice in these kind of situations. All right, the last thing I'm going to talk about, and then I'll answer any other questions that you guys have, but related to homeowners insurance. What can you do to protect yourself? Well, first of all, if you are a current homeowner, you need to look at your insurability. You need to look at your home. You need to trim trees that are touching the house. You need to make sure there's no moss on the roof. You really need to get rid of that trampoline that's in the backyard. You need to make, if you're in a high fire zone, you need to create defensible space. And if you hear from your insurance company saying that we are issuing you a notice of cancellation, do not roll over and play dead. You need to protect yourself, find out what their issues are, find out what you can do to satisfy what they're looking for so that you can maintain that insurance. And if you are a future home buyer, start talking to an insurance guy early. Figure out who your insurance guy is while you're in the process of shopping for a home. Do not wait until you're in escrow to figure out, oh, now I should probably pick somebody as my insurance person. Have that conversation early. Talk to me. Talk to your real estate agent. Talk to your friends and family. Figure out who your homeowner's insurance agent is going to be early in the process. All right, I've got time for questions. So anybody who's watching live, feel free to ask me questions. I know there's a couple that are on here. If you have more questions and you're watching live, post them now. If you're watching recorded, then you can post the questions. I'll get back to them later. And just as my reminder, I am not a nonprofit organization. I am here to take care of you long-term, and I am here to take care of all of your mortgage needs. So if you need help, scan this QR code and I'll be here to help you out. All right, so let's take a look at the questions here. First of all, SP has two things that they're saying. Your number in the Central Valley dropped 10 spots on Wednesday. No, that's just normal. Like I saw the same thing. I had another client in the Central Valley, as a matter of fact, that went from number 11 to number 1. So I saw a big jump. I don't think it's anything unique. It's just the CalHFA is being very aggressive at chasing down people with vouchers to figure out, hey, are you using it or not? If you're stale, if you've had a voucher for a long time, the people who just got vouchers that never opened their email, CalHFA is chasing them down. Hey, did you see that you got a voucher? Are you still interested in using it? They're trying to get this money spent as quickly as they can. And so they're not going to just sit back and wait for vouchers to expire. And that's what I am seeing and expecting. All right. So you're saying I don't agree with that. Rent is down a lot. Oh, okay. So this is where I was talking about, mom and dad, they lose their home. They have to pay more in rent. So rent's down in a lot of areas. And those people who are house poor just need to live within their means. I get it. And I understand where you're coming from, but we all have a standard that we adopted when we purchased a home. And at that moment, whether it was in 2015, 2020, 2024, you said, I can afford and I'm willing to commit this much money in order to afford a home. And for a lot of people, look, that it's okay to be house poor. I hate that term, but I get where you're coming from. It's okay to be house poor. But when things happen that make it significantly more expensive, you don't have a choice. If you're house poor and your insurance just went up significantly, you can't afford your payment anymore. So now your only option is to sell the home and go become a renter, which is fine. And I get that you're saying rents are down in a lot of areas, but not compared to what their mortgage payment was. Remember, they have a 2.75% interest rate with a $300,000 loan amount on a house that's worth $500,000. And you're going to say, whoop-de-doo, they've got $200,000 that they're going to cash out of that house when they sell it. They sure do. But at some point in time, that 200 grand is going to run out. And my point is, maybe that was the money that they had that they were planning to use to retire on. And now instead of having that money to retire on, they're going to have to continue to work much longer into retirement. Again, we can all say, boo-hoo, tough for them. Well, the truth is, every single one of us is making plans in our life. We are making plans to create a better life, both for ourselves and for generations to come. And a lot of those plans revolve around home equity, because for most people, the equity in their home is the single largest amount of wealth they will ever build. And this is jeopardizing that. This is putting people in a position where, hey, yeah, I can pull that cash out. I can sell the house. I can pull that cash and I can live off of that. But that creates an opportunity cost where they lose the opportunity to do something else with that money. And they have worked their entire life. They've been house poor, as you say, for their entire life so that they can be in this position. They've had delayed gratification. All the best money gurus say delayed gratification. If you just wait and not focus on instant gratification, you will have all the things you want later on in life. And I believe that's very, very true. But things like this insurance crisis, this is jeopardizing that, because these people have done well in creating wealth in their home. They took a risk, they bought early. All risks come with the fact that the risk could fail. This is one of the things that cause it to fail. And I'm trying to make it really clear. I don't think that anybody is right or wrong. I don't think that anybody is entitled to anything, but I do think that we need to have our eyes open. And this insurance crisis isn't just an affordability issue for new homeowners. And it for sure is an affordability issue. It's another piece of the pie that says rates have gone up, house prices have not gone down. And I'm in a position where if I want to become a homeowner, I'm going to pay even more. And now it's going to be even more because now I'm going to pay more in insurance. And the reward for doing that is the long-term wealth that you are building. But guess what? When you're somebody who has taken all of that time to build all of that long-term wealth, and then it's taken away from you at the end because of an insurance crisis, that's pretty disheartening. All right. So let's see. That makes sense. Thank you. Is there a way for CalHFA to call CalHFA and figure out how much money is left in our area for Dream for All? I don't want to wait around if 120 is too far-fetched. You can call them, give them a call. Let's see what they say. I think 120 in the Central Valley is tough. I don't think there's a good shot at you getting the money. That's my gut feeling, but you for sure can call Calhafa. I don't know if they'll give you that information, but I think it's worthy of you to ask. So they do have an 800 number. You can call the 800 number that's on their website. And I've had people tell me they called and got some good information from them. I've had other people call me and tell me that they didn't answer their questions, but I think that it's worth asking. All right. Is it recommended to take homeowner insurance at the same, is it recommended to take at-home insurance at the same national seller? So you might want to rephrase that, but what I'll tell you is if you're talking about with your car insurance company, we call that bundling. And a lot of homeowners insurance companies won't give you homeowners insurance unless you bundle your car insurance, because that's how they make money overall. Because they're saying, hey, I'm allowed to charge more on car insurance and I can make more profit on car insurance. And so I'm willing to take the bigger risk on homeowners as long as I'm also making the bigger return that comes from the car insurance. Nick, can I get a chance to change? Yes, you can change your homeowners insurance at any time. Be careful, because as this crisis gets worse, the options may get less. You may have fewer options. You can change your homeowners insurance even if it's included in your mortgage payment. So you always pick your insurance company. Sometimes you can also pay your insurance company directly. Sometimes you have to include it in your mortgage payment, but it's always the insurance company you picked. And at any point in time, you can change insurance companies. Your mortgage company would get a notification from the new insurance company. They would refund the money that had been prepaid to the old other insurance company. So there's ways to make it happen. I'm not going to go too deep into how to do it, but yes, you can change your insurance company later. But it's not hard, but it's not simple. So I wouldn't say plan on it. I wouldn't say, it's super easy. It's no big deal, because you prepaid a year to one insurance company. The new insurance company, in order to take you on, needs to get prepaid for their year. You're going to get a refund from the first insurance company, but you got to get the money to the new company before you got the money back from the old company. And there's a bit of movement of money thing that creates an issue, but it for sure can be done, especially if you time it around your renewal dates. That's the best time to do it. You renew once a year with your insurance company. That's exactly what your next statement was. After purchasing a year or so, do it on your renewal dates. So on the anniversary of your insurance policy, they renew and start a new policy. Your mortgage company will send a check to your insurance company about a month before the renewal date. So about 2 months before your renewal date, you're going to want to shop for a new insurance company. You're going to ask them to get you a policy that starts the day that your old policy ends. And then you're going to send that quote to your mortgage company. The mortgage company, instead of paying the old insurance company their following year's premium, they're just going to write a check to the new insurance company, and it's going to be a seamless transition. So that is the easiest, cheapest, best way to change insurance, is to change it on your anniversary date of your renewal. Now, that normally is the anniversary date of your home purchase, but sometimes it ends up being a different date. But yes, that is the best and easiest way to change your insurance. All right, guys, it looks like that is it for questions. I really appreciate everybody joining me. Hopefully this has been valuable information. I'll continue to share as much as I can. Next week, I will be doing a special broadcast about the economy and what's going on with inflation and unemployment, and what the new presidential administration is going to mean to that, in my opinion, and kind of give you a feel for what's happening with the Federal Reserve. And then beyond that, I've got some other videos that are going to be coming out on my other channel, so stay tuned. I really appreciate all of you, and I hope everybody has an absolutely wonderful weekend. Talk to y'all soon. Bye-bye.